Roger Montgomery from rogermontgomery.com. Well, we might cross over straight away to Roger, who's had a couple of wins in the mining space recently. I'm aware of Matrix and Forge, been very, very good performers. So good start for the year, mate. What else has been happening?
We've bought various stocks, and in the fund that we run, we've picked up some shares. I have to admit, not all this year, some of them last year. A company called Vocus Communications. Like it because it's a business that reminds me a lot of toll roads. The only difference between it, I think, Michael, if we were having a dinner party and you asked me what I did and I said to you, I own a toll road, your mouth would drop, your jaw would drop, and you'd say, gee, that's all right. Yeah. But the problem with toll roads, of course, is the cars go to sleep at night. They get put in their garages. Whereas the internet toll road, the cable that sits between the United States and Australia, part of which, or some of the bandwidth of which Vocus resells, it's running all the time, and as more mobile devices come on stream, people are constantly getting their Twitter feeds and their RSS feeds and downloading their emails even while they sleep. And Vocus is clipping the ticket, and it's been an excellent performing business.
It's had a big run. It was $2 up to $2.80 now or something, is it? I think last time I looked today. Still looking good value.
I'm not sure. Did it get over $3? It might have been over $3. I don't know, but I don't look at it every day. But look, I think that business could potentially be 4 or 5 times bigger in just a few years' time. And it's run by some pretty smart people.
Waiting on the line from the Sunshine Coast. Hi, Mark. How can we help you?
Evening, gentlemen. Thanks for taking my call. Yeah, I've got a question about AMP.
Some quick stats. Back in 2005, the intrinsic value, my estimate of its intrinsic value was 351, and in 2012 it'll be 361. So there's been no change in intrinsic value. It hasn't added any wealth for shareholders, and the share price reflects that. The share price today is about where it was back in 2004.
Well, thank you for that. Look, the other thing I want to talk about was Woodside. Michael, you and I were just discussing it.
The issue is that this is a business that up until now hasn't made a profit. The expectation is that it will next year, the year after, and the year after that, and the projections have that hockey stick look about them. But I'd like to see some evidence of that. I rank companies, as you know, from A1 down to C5, and because of its history, at the moment it gets a C4, which is the second lowest rating in terms of quality. Different issue to the issue befalling ERA. ERA is a mine life issue. That's not the issue here. They're my concerns. I think I'd like to see some runs on the board. I'm happy not to be in on the ground floor. I'm happy to get on level 1 or level 2 and see a demonstrated track record.
I think it's fair enough. Michael, how can we help you?
Good evening. Thanks for taking my call. I'd like the panel's opinion on TFS Corporation. The code's TFC. I'm particularly interested in what the company's intrinsic value is.
Roger, let's start with you.
Look, the intrinsic value of this business is a little bit higher than where it's currently trading, not a lot higher. And I mean, you're talking 5 or 10% or thereabouts. The problem for this particular business is its cash flow.
Right.
If you have a look at the cash flow statement, you have a look at how much money they've earned from operations and what they've had to reinvest in the business. They've had to raise a lot of capital in order to actually fund the business. And that's my problem with this company. Its cash flow is weak. It's done, I think it did another capital raising just this year, in fact.
Right, okay.
And I haven't seen any evidence yet that it's self-sustaining. So they would argue they're in an expansion phase, and that's what they need the money for. I'd like to see some cash generating ability from the business, and like to see it stand still for a bit to see exactly what it's able to earn. That's my problem with it.
Okay, good stuff. Michael, is that on your radar at all?
No,
that's okay.
No, it's not on my radar, and I'd agree with what Roger said.
Roger, let's start with you.
Look, the intrinsic value of this business is a little bit higher than where it's currently trading, not a lot higher. And I mean, you're talking 5 or 10% or thereabouts. The problem for this particular business is its cash flow.
Right.
If you have a look at the cash flow statement, you have a look at how much money they've earned from operations and what they've had to reinvest in the business. They've had to raise a lot of capital in order to actually fund the business. And that's my problem with this company. Its cash flow is weak. It's done, I think it did another capital raising just this year, in fact.
Right, okay.
And I haven't seen any evidence yet that it's self-sustaining. So they would argue they're in an expansion phase, and that's what they need the money for. I'd like to see some cash generating ability from the business, and like to see it stand still for a bit to see exactly what it's able to earn.
Okay.
That's my problem with it.
Okay, good stuff. Good, thank you.
A company called FSA Group. The code is FSA.
Yeah.
And I just like the panel's thoughts and the intrinsic value.
I've owned Credit Corp for a little while now, so I actually own Credit Corp and like it, and think its intrinsic value is substantially higher.
Right.
FSA is a slightly different business. My issue with this particular business is that the management of this business in the past have been spread a little bit thin. They've had other business interests and other investments, and I've always been concerned that if they're not entirely 100% focused on one business, then that means the performance of the business can suffer. It doesn't rate as investment grade for me, unfortunately. It's a B5. Yep. If it was a B2 or a B3, I might take an interest, but as a B5, it's not something that I'm interested in, despite the fact it's at a discount to my estimate of its intrinsic value.
Okay.
So I've got the intrinsic value at almost 30% higher than the current share price. But because it's not investment grade for me,
it's still not enough.
I'm not confident enough to buy.
Neutral Bay, and he's written in and said he's recently bought a parcel of Macquarie Bank shares at $40. It was about 6 months ago. He's been disappointed by the share price performance, which sounds fair enough. In particular, in recent weeks where the rest of the market has performed well, but Macquarie Bank has deteriorated to around 34, 35. He's interested in the panel's view, whether it's worth holding onto the stock, and particularly if they're aware of any catalysts or events that would help the stock price recover. In short, is there a reason to hold on, or should you let it go and try to do better somewhere else?
Base my valuations very simply on the performance of the business and nothing else, not everyone else's views. This is a business that has obviously lost favour in the marketplace, and there's a very good reason for that. That feed generating model that it had, the GFC has put an end to that. The I guess lack of sustainability of the model, like the MIG, the Macquarie Infrastructure Group type model, that wasn't sustainable. Borrowing money basically to pay distributions and to borrow against the revaluations, constant revaluations of the roads. I think that wasn't going to work, and we've seen that with Lynch at Transurban. He said, look, that old model doesn't work. We can't keep paying these high distributions anymore. So Macquarie's lost. It's lost that ability. It's a different beast to what it was. Michael said earlier that it's different to the other banks. Not only is it different to the other banks, it's different to the bank it was. And I think we've got to wait and see what actually transpires.
Transurban, because I wouldn't mind. Let's just talk about that for a minute, because I know that's still recommended on a lot of people's lists as a buy, yield play, etc., etc. I think it's been cheap at $5.20 for a long time. We'll start with you, Roger. You just mentioned it. We'll come back to Michael.
I think I've spent quite a bit of time soul searching about Transurban. I had a very firm view about this particular business, and I really was of the view that I couldn't see how you could continue to pay increasing distributions, pay down the debt, hand the roads back to the various governments debt free, all at the same time. I'm less concerned about that now. You have to look at this particular business on an individual asset basis, and I don't see that there's any risk. I don't see that there's... Well, actually, I should never ever say that there's no risk. There is some risk. But the risk for me is mitigated by the structure. It's also the reality, and the reality is people who look at businesses the way I talk about in my book, if they just take my valuation approach and apply it to Transurban, they'd never buy it. What you have to understand is that it depreciates its roads. Now, the whole concept of depreciation is based on the idea that something needs to be replaced. Well, arguably, the roads never need to be replaced. So depreciation overstates the cost of actually running the roads, particularly in the early years. So this is a business whose cash flow is actually substantially better than what's being reported. The difficulty, I think, is that it's a very simple business to run. People running the business are getting paid a lot of money, and you wonder whether or not they're running it in the best interests of shareholders or whether they're running in the best interests of themselves. And it's a fair question for any investor to ask at an AGM or anywhere. I think the people who invest in this type of business, the Canadian super fund, pension funds,
they get 20-year views, don't they? Yeah.
Well, and they're not looking to shoot the lights out.
Yeah.
Many viewers on this program are looking to make 30-40%. This is not going to do that. The infrastructure funds that invest in a company like Transurban, they're happy to get CPI, and if they could get 5% on top of CPI, they'd be absolutely ecstatic. So it delivers what they need.
Sorry. After that one, Sorry. But it's good. They're still cheap, and you're happy with it, low risk.
Coming back after the break, Roger Montgomery.